about portfolios. You can see here that there is a calculation already for portfolios. When we get to that chapter, we're going to add here the actual investments in assets A, B, and C, so we can see the statistics for the portfolio itself. So, since I've let the cat out of the bag, let's go ahead and talk a little bit about portfolios. It's a collection of financial assets. We're going to assume that most investors are rational and therefore they're risk averse. So they're typically going to always choose to invest in portfolios rather than single assets. Why do they do that? It's because of the old saying, putting all of your eggs in one basket. You don't ever want to do that. The topic or the statistical discussion of that is all about this idea of diversification. If you hold portfolios, you're going to diversify away some of the risk. Some of the risk that you're subjected to, you will not see. It will not hurt you. You won't feel it in your returns. So again, putting all your eggs in one basket implies higher risk levels. So in real world situation, the risk of any investment certainly is not going to be viewed independently. Right? We're always going to be talking about portfolios when you talk about people. So if you're going to decide to have a new investment, you have to consider what is going to be the impact of risk and return on your current portfolio of assets. Certainly you would want to get a higher level of return. But as we've discussed, if you get a higher level of return, you may also expect to get a higher level of risk. If we can manage our portfolios and our investments correctly, when we combine them, we may find times when we can increase return and reduce risk. In fact, that's our ultimate goal. We want to create something referred to as an efficient portfolio. This is a portfolio that gives us the highest possible return for a given level of risk. So find something that's going to get me the most return possible for my investment dollar, but I also want to find that portfolio that has the least amount of risk. So how do you find the return on a portfolio? The formula is a weighted average. So the W here talks about the proportion. How much money do you have invested in each asset? But it's put in there as a proportion of your total portfolio's value. R, of course, is the expected rate of return on the asset itself. So here we're going to put 100 shares in that Walmart stock from a while ago. It's selling at $55 a share. So we're going to have $5,500 in Walmart. We're going to have $2,500 in Cisco. So what are those two holdings? Well, if you add the two together, we have a total of $8,000. 68% is going to be in Walmart. That's the $5,500 divided by 8,000. And 31.25% is what's invested in Cisco. And if you add those two together, 68.75 plus 31.25, that averages up to 1.0. So all of our money is accounted for and all of our money is invested. So let's go back to those assets that we were talking about a little bit earlier and do some portfolio analysis. We're going to put 70% of our money in asset A and 30% of our money in asset B. In that standalone risk worksheet, here's where you input the weights. If you put 70% in A and 30% in B, that adds up to 1. That means there's nothing invested in asset C. So what does our portfolio look like? Well, our average return, we're going to get 15%, but our risk is somewhere in between these two, somewhere between 0.094 and 0.37. So we have a risk level that's an average of those two things. Excuse me. So again, we know what the risk is and we know what the calculation of return is. So what if we now incorporate asset C? Let's put asset C in the mix. So I'm going to put 70% of my money in B and 30% of my money in C. So how does that work out? Well, if you look over here, here's our portfolio. Our average rate of return is now 12.15. We get a little bit less risk than what we had before. What also then happens to our standalone risk? Obviously, see here that we end up with an 18.99 is the coefficient of variation. So again, you can see that the average is somewhere in between those two assets. What if we combine them all? 30% in A, 50% in B, and 20% in C. Again, we end up with an average that's in between the three portfolios. And of course, in this case, 0.164 is the amount of relative risk that we have for investing in this particular portfolio. Let's go back and look at the returns. We have 15% in each one and 5.5 in each. If we put those weights in this portfolio, again, this is the portfolio beta and return worksheet. You can either put dollars in here or you can put the percentages, right? We're going to end up with 13.1%, which is exactly what we got on the previous slide. So how does this concept of diversification work, right? We're talking about risk. How do we do the calculations? How do we put this all together and kind of reconcile the outcomes that we're seeing? Well, the statistic that makes this whole world go round is something called correlation. It is a statistical measure that tells us how two series of numbers seem to act alike. They can be positively correlated, that is, they can act alike, or they can be negatively correlated. In fact, they could be what was referred to as being perfectly positive, means they have a correlation of +1, perfectly negative, they has a correlation of -1. So those are the two extreme parts. So correlation is somewhere between +1 and -1. So in order to reduce risk, we need to combine assets together that ultimately don't act alike. We want them to have lower correlation than +1. An uncorrelated two series means basically they have no interaction, so the correlation coefficient is going to be 0. So again, since that is obviously less than the highest, we would have less risk in those two assets than you would have in a portfolio that had two assets that had a +1 correlation. So here we have two assets, low and high. 6% is the expected return for low, 3% is the standard deviation, 8% is for high, 8% is the standard deviation. So again, the performance of these, right, it makes a little bit of sense. The lower risk thing has less returns, right? So what if we put an equal investment in both of these assets? So we put, again, we switch to another spreadsheet, and then this particular spreadsheet, we have, it's called the portfolio risk spreadsheet. But essentially we put here's the portfolios, we put equal amounts in each. Here are the returns, 6% in A, 8% in B, and here's the variance. Now, to calculate variance, how I got this number, standard deviation is the square root of variance. So I took 3% and squared it. That gives me variance. Now, in this first instance, we're going to say that the correlation is 1.0, that they're perfectly positively correlated. If you do this, the expected rate of return is 7, standard deviation is 5.5, and portfolio coefficient of variation is 0.786. So now what happens if we go to, and we say, well, the correlation is actually 0.5. Down here we have matrix, the correlation matrix, we type in 0.5, you get the same rate of return, but look what happens to the portfolio of, or the coefficient of variation. It's now less. So risk goes down as correlation goes down. What happens if we had -5 correlation? The standard, the coefficient of variation goes down even further to 0.5. So if you have two assets that are identical, but we can look at how different assets vary, right, as far as relationships, the lower the correlation, the more risk diversification that you ultimately get. So again, we can go back to this problem with the three assets, and in this case, I wanted to input correlation. This is the correlation that comes from the calculation from the standard, standalone risk worksheet. So we just input our data. We found the variances. We can type those in. Here's the returns. Here's the portfolios. We get these correlations from that worksheet. So the correlation between A and B is 1. Between A and C is -0.96. And from B and C is also -0.96. So based on that, this correlation, we end up with this 3.1 is our return, and the coefficient of variation is 0.164. So we have this change, this combination, several worksheets that will help us. This is obviously, again, the portfolio risk and return worksheet that will help us do the calculations to find and to be able to calculate fairly complicated formulas for risk and return of an asset. Now, just to kind of conclude a little bit of this chapter, let's think about how different assets are related to each other. The first thing we talk about is stocks and bonds. Stocks and bonds are negatively correlated with each other. So if you want to reduce risk, you need to have a portfolio that combines both bonds and stocks. That will get you more diversification. Add on to that the idea that different countries are correlated. Their economic situations are different than what the United States is. So their economies are not correlated, so their markets will not be correlated. So now if we incorporate international stocks and bonds, we should be able to get even more diversification. Now the one thing that's true is once we add international things, we add different levels of risk as well, right? So it won't be as straightforward, but there will be other risks that we have to be concerned about when we invest internationally. So that's the end of part one. It's a big chapter. This is a very important concept. It's probably going to take a couple of weeks for this to filter through and get into your mental psyche, if you will.